Hey everyone, if you watch this video until the end, you'll have more chances to make money on your investing journey. So, try to watch it completely. Today, we will talk about Enhanced Dollar Cost Averaging, EDCA. What is EDCA? I searched YouTube for Enhanced Dollar Cost Averaging, EDCA. Although there are many videos on dollar cost averaging, DCA, there are none on EDCA. So, I think this is the first YouTube video on EDCA. In my previous video, TQQQ $1,000 Challenge, July 2024, I mentioned this strategy as follows. Some experts think the Nasdaq may go down 5 to 10% for a short period in September and October of 2024, especially after the interest rate cut. Historically, September is often considered one of the weaker months for stock market performance. If that happens, I plan to buy more than $1,000 of TQQQ during this month. For example, if TQQQ goes down about 20%, I'll buy $2,000 worth. If it goes down about 30%, I'll buy $3,000 worth. This strategy, called Enhanced Dollar Cost Averaging, EDCA, means we'll invest more during market lows and less during market highs. Okay, we will discuss 4 papers first. Then, I will show 5 additional examples of doing EDCA. So, we will have a total of 9 examples of EDCA. Although there are many different variations of DCA, I will call all variations EDCA. Paper 1. Building a Better Mousetrap, Enhanced Dollar Cost Averaging. Let's talk about the first paper. If you Google Enhanced Dollar Cost Averaging, EDCA, you will see this explanation. The EDCA strategy invests a fixed additional amount after a down month and reduces the investment by a fixed amount after an up month. This is based on the paper, Building a Better Mousetrap, Enhanced Dollar Cost Averaging. The paper explores an investment strategy called EDCA. This strategy is designed to improve upon the traditional DCA method, which is commonly used by investors to mitigate the risk of market volatility. 1. EDCA. EDCA is a rule-based strategy that adjusts investments based on new market information, unlike traditional DCA, which invests a fixed amount regardless of market conditions. The strategy involves increasing investment amounts after a market decline and decreasing them after a market rise. 2. Simulation results. The EDCA strategy consistently outperforms traditional DCA in terms of higher dollar-weighted returns and greater terminal wealth. The improvement is most significant for high volatility assets and during secular bear markets. Historical backtesting on equity indexes and mutual funds shows that EDCA can enhance investor returns by 30 to 70 basis points per year. 3. Behavioral finance aspect. Traditional DCA is appealing because it helps investors avoid the psychological pitfalls of market timing and reduces regret by following a consistent rule. EDCA retains these behavioral benefits while incorporating market feedback to optimize returns. 4. Implementation. EDCA can be directly applied to portfolios where investors have control over their periodic cash flows. For defined contribution plans, implementing EDCA would require adjustments in how contributions are managed, potentially involving coordination with portfolio managers and administrators. In conclusion, the paper argues that EDCA is a simple yet effective enhancement to traditional DCA, offering better returns and maintaining the psychological comfort that makes DCA popular among investors. Example scenario. Consider 2 investors, Alice and Bob, who both plan to invest in the stock market over a period of 30 years. They start with an initial investment plan of $100 per month. Alice's traditional DCA approach. Alice invests $100 every month, regardless of market conditions. Bob's enhanced DCA approach. Bob follows the EDCA strategy by adjusting his monthly investments based on market performance. If the market goes down in a particular month, Bob increases his investment for the following month by a fixed amount, say $20. If the market goes up, Bob reduces his investment for the following month by $20. Bob's enhanced DCA scenario. January. Market down by 5%. Bob invests $120 in February. February. Market up by 3%. Bob invests $80 in March. March. Market down by 2%. Bob invests $120 in April. This pattern continues throughout the year. Performance comparison. After 30 years, Bob's strategy would likely result in higher average returns and greater terminal wealth compared to Alice, due to the strategic adjustments based on market performance. Paper 2. Weighted and pure dollar cost averaging strategies in various asset classes. Next, let's discuss the second paper, Weighted and pure dollar cost averaging strategies in various asset classes. This paper explores modifications to traditional DCA using the Relative Strength Index, RSI, and the Volatility Index, VIX. Here's what they found. 1. RSI weighted strategies. Increasing investments when RSI values are below a lower bound and decreasing them when RSI values are above an upper bound significantly outperform traditional DCA for Bitcoin, crude oil, and the Nasdaq. For example, Nasdaq. Sharp ratio of 1.923 versus 0.0491. 2. VIX-weighted strategies. All tested VIX-weighted strategies underperformed compared to pure DCA. However, an inverse application might yield profitable results. In conclusion, RSI-weighted DCA strategies offer a viable improvement over traditional DCA by enhancing profitability while maintaining simplicity, making them accessible for retail investors. Example scenario. Pure DCA in stock XYZ. You decide to invest $1,000 per month in stock XYZ over 6 months. The price of stock XYZ fluctuates each month. With pure DCA, you invest a fixed amount, $1,000, each month regardless of the stock price. Example scenario. Weighted DCA based on RSI for stock ABC. You decide to invest in stock ABC using a weighted DCA strategy based on RSI. When the RSI is below a certain threshold, e.g., 30, indicating the stock is oversold, you invest more. When the RSI is above a certain threshold, e.g., 70, indicating the stock is overbought, you invest less. Your average cost per share during DCA is $91.86. In contrast, your average cost per share during weighted DCA based on RSI is lower at $60.02. These examples illustrate how both pure DCA and weighted DCA strategies can be applied to stock investing, demonstrating the potential benefits of adjusting investment amounts based on market indicators such as RSI. Paper 3. Smart Dollar Cost Averaging, Smart DCA. This paper presents an investment strategy called Smart DCA, designed to improve upon traditional DCA. The authors demonstrate that Smart DCA, which adjusts investment amounts based on price levels, is mathematically superior to DCA in any market condition. The strategy involves regularly investing an amount inversely proportional to the current price of the asset, resulting in better cost efficiency. Example scenario. Next, let's explore Smart DCA, where you adjust your investment amount based on price levels. During dips, when prices are below $100, you invest more, $1,500, and during peaks, when prices are above $100, you invest less, $500. By adjusting your investment amounts based on market conditions, the EDCA strategy allows you to acquire more shares during market dips and fewer during peaks. This can lead to a lower average cost per share and potentially better investment outcomes over time. Paper 4. Augmented Dollar Cost Averaging. The fourth paper, Effectiveness of Augmented Dollar Cost Averaging, introduces the Augmented Dollar Cost Averaging, ADCA, strategy. ADCA conditions investments based on prevailing economic conditions, being more aggressive during expansions and conservative during contractions. ADCA adjusts investment amounts based on economic indicators like market volatility, unemployment rate, and business capacity utilization. ADCA offers significant risk-reducing benefits compared to lump sum investing. Example scenario. You decide to invest $1,000 per month in a diversified stock portfolio. You adjust your investment based on economic indicators like market volatility, VIX, unemployment rate, and capacity utilization. In these examples, ADCA adjusts the investment amounts based on prevailing economic conditions. During economic expansions, low volatility, low unemployment, high capacity utilization, investments are increased. Conversely, during economic contractions, high volatility, high unemployment, low capacity utilization, investments are decreased. These examples and findings from the 4 papers provide valuable insights into various EDCA strategies. Now, let's talk about the other 5 examples. The example number 5 is standard EDCA as follows. Standard EDCA. Base investment, $1,000 per month. Adjustment factor, 10%. If the asset's value increased by 5% last month, you invest $1,000. 10% of $1,000 equals $900. If the asset's value decreased by 5% last month, you invest $1,000 plus 10% of $1,000 equals $1,100. The example number 6 is modified EDCA as follows. Modified EDCA. Base investment, $1,000 per month. Modification factor, 10. If the asset's value increased by 5% last month, you invest $1,000. 10 by 5% equals $500. If the asset's value decreased by 5% last month, you invest $1,000 plus 10 by 5% equals $1,500. The example number 7 uses moving averages. Using moving averages. 1. Baseline schedule. Invest $500 monthly in an ETF like the S&P 500, SPY. 2. Market indicator. Use the 50-day moving average, MA, as an indicator. 3. Adjustment rule. If the SPY price is below the 50-day MA, increase the investment by 20% to $600. If the SPY price is above the 50-day MA, decrease the investment by 20% to $400. Scenario. In January, SPY is below the 50-day MA. You invest $600. In February, SPY is above the 50-day MA. You invest $400. This approach allows you to invest more when the market might be undervalued and less when it might be overvalued. The example number 8 uses the Relative Strength Index, RSI. Using RSI. 1. Baseline schedule. Invest $300 biweekly in a technology ETF like QQQ. 2. Market indicator. Use the 14-day RSI as an indicator. 3. Adjustment rule. If the RSI is below 30, indicating the market is oversold, double the investment to $600. If the RSI is above 70, indicating the market is overbought, halve the investment to $150. Scenario. In week 1, RSI is at 25. You invest $600. In week 3, RSI is at 75. You invest $150. This strategy helps you take advantage of market corrections by investing more when prices are low and less when prices are high. The example number 9 uses the Fear and Greed Index. Using the Fear and Greed Index. 1. Baseline schedule. Invest $200 weekly in an emerging markets ETF like Emerging Markets ETF, EEM. 2. Market indicator. Use a market sentiment index such as the Fear and Greed Index. 3. Adjustment rule. If the index shows extreme fear, increase the investment by 50% to $300. If the index shows extreme greed, decrease the investment by 50% to $100. Scenario. In week 1, the index shows extreme fear. You invest $300. In week 2, the index shows extreme greed. You invest $100. This approach leverages market sentiment to adjust investments, buying more during market downturns and less during exuberant periods. Summary. Benefits of EDCA. 1. Potential for higher returns. By investing more during market dips and less during peaks, you can potentially enhance returns. 2. Reduced risk. Diversifying investment amounts based on market conditions helps manage risk better than a fixed amount strategy. 3. Systematic approach. EDCA provides a structured yet flexible method to adjust investments based on market dynamics. EDCA refines regular investing by adding layers of strategy through market indicators. This method can offer better returns and risk management compared to traditional DCA. Remember to choose indicators and rules that align with your investment goals and risk tolerance. These examples illustrate how EDCA can be tailored to different risk tolerances and investment goals. Would you like to explore any specific scenario or need further details on implementing EDCA?